Hello everyone, and welcome back to the channel. Today, we rate tackling a topic that affects almost all of us but can sometimes feel a bit mysterious: insurance. What exactly is it? And how does it really work? Stick around, because by the end of this video, you'll have a crystal clear understanding. So, let's start with the basics. At its core, insurance is a financial safety net. Think of it as a contract called a policy between you and an insurance company. In this contract, you agree to pay a regular amount of money, known as a premium, in return. The insurance company promises to provide financial protection against specific types of losses or damages. It's a way to manage life's what-ifs. The magic behind insurance is a concept called risk pooling, or sharing the risk. Imagine a community of 1,000 homeowners. Statistically, it's highly unlikely that all their houses will face a major disaster, like a fire, in the same year. Maybe one or two will, but probably not more. So, instead of each homeowner having to save up a massive amount of money to cover a potential catastrophe, they all contribute a much smaller amount their premium into a large shared pot of money. This collective fund is managed by the insurance company. When one of the homeowners in the group unfortunately experiences a covered disaster, like that house fire, they can file a claim. The insurance company then uses the money from the shared pot to help the homeowner cover the costs of rebuilding or repairing their home. In this way, the financial burden of a huge, unexpected loss is spread out among a large group of people, making it manageable for everyone. The risk is transferred from the individual to the group. Of course, not all risks are the same, and that's why premiums vary. Insurance companies employ experts called actuaries. These are the math wizards who analyze vast amounts of data to calculate the probability or likelihood of a specific event happening. They look at factors like your age, your health, where you live, what kind of car you drive, or the type of business you run. For example, a 20-year-old driver with a brand new sports car is statistically more likely to be in an accident than a 50-year-old with a perfect driving record in a family sedan. Therefore, the younger driver's car insurance premium will likely be higher because they represent a greater risk to the insurance pool. The company needs to collect more from higher-risk individuals to ensure there's enough money in the pot to cover potential claims. It's all about balancing the scales of probability. Now, let's talk about some of the key terms you'll encounter when dealing with insurance. We've already mentioned the premium, which is your regular payment to keep the policy active. Then there's the deductible. This is the amount of money you have to pay out of your own pocket for a covered loss before the insurance company starts paying. For example, if you have a $500 deductible on your car insurance, and you get into an accident that causes $3,000 worth of damage, you would pay the first $500. Another important term is the policy limit. This is the maximum amount the insurance company will pay for a covered loss. If your home is insured for $300,000, that's the most the company will pay out, even if the cost to rebuild is higher. That's why it's crucial to make sure your coverage limits are adequate for your needs. So, what kinds of things can you insure? Well, just about anything with financial value that is subject to risk. Let's run through some of the most common types. First, there's health insurance. This is a big one. It helps cover the costs of medical care, from routine doctor visits and prescription drugs to major surgeries and hospital stays. Without it, a serious illness or injury could lead to overwhelming medical bills. Then we have auto insurance. In most places, this is legally required if you own a car. It covers damages to your vehicle and liability for any injuries or damages you might cause to others in an accident. Homeowners or renters insurance is another staple. It protects your dwelling and your personal belongings from things like fire, theft, or certain types of natural disasters. It also typically includes liability coverage in case someone gets injured on your property. Life insurance is a bit different. It doesn't protect you, but rather your loved ones. If the insured person passes away, the policy pays out a sum of money known as a death benefit. To their designated beneficiaries, this can help a family cover funeral expenses, pay off debts, or replace lost income. There are many other specialized types to, like disability insurance, which replaces a portion of your income if you're unable to work due to illness or injury, or business insurance, which covers risks associated with running a company. Each type of insurance is designed to protect a specific area of your financial life. So, how do you actually use your insurance? The process starts when a covered event occurs. Let's stick with our car accident example. The first step is to document everything, take pictures, get a police report, and exchange information with the other driver. Then, you contact your insurance company to file a claim. You'll provide all the details about what happened. The insurance company will then assign a claims adjuster to your case. The adjuster's job is to investigate the incident to confirm that it's covered by your policy. They'll review the police report, talk to witnesses, and assess the damage to your vehicle. They determine how much the repair will cost and how much of that cost is covered under your policy, taking your deductible into account. Once the claim is approved, the insurance company will issue a payment. This payment might go directly to you, or it could go straight to the auto body shop that is repairing your car. The goal is to indemnify you, which is a fancy word that means to restore you to the same financial position you were in before the loss occurred. Insurance isn't designed for you to make a profit, it's designed to make you whole again. In summary, insurance is a powerful tool for managing financial risk. It operates on the principle of sharing that risk among a large group. You pay a small, predictable premium in exchange for protection against large, unpredictable losses. It provides peace of mind, knowing that if something unexpected happens, you won't have to face the financial fallout all on your own. It's a safety net that allows us to build our lives, buy homes, drive cars, and run businesses with greater confidence and security. I hope this breakdown has helped demystify the world of insurance for you. It's a fundamental part of modern financial planning, and understanding how it works is the first step toward making sure you and your assets are properly protected. If you found this video helpful, please give it a thumbs up. It really helps the channel grow. And if you have any questions, drop them in the comments below. I'll do my best to answer them. Don't forget to subscribe and hit that notification bell so you don't miss our next video. Thanks for watching, and I'll see you in the next one.